Hi, everyone. Thank you for joining us again for another episode of our Andrew's Insights. As always, you have me, Scott, and we have Travis on as well. Travis, how are you doing?
I'm doing well, Scott. So far, it's been a great week, and it's only Wednesday. So, looking forward to the rest of the week here. But been spending some time
Yeah.
with family. I've been spending some time taking walks around the neighborhood with the dog. So, everything's been good.
Well, you're enjoying all that Kaka'ako has to offer and living the millennial dream in Hawaii.
Yeah, it's all coffee and avocado toast here. So it's been great.
There you go. There you go. Well, today we have a great topic talking about our investment process, how we view things as a local independent firm in Hawaii. And I think starting off, Travis, the question is, where does the investment process begin for you and for our team?
Yeah, that's a great question because every individual will have their own set of circumstances. It's important that we start with identifying situation, getting to know what their goals are before we prescribe any solutions on the investment side. So we always start with a conversation about what are your goals, right? Where do you want this money to take you during your lifetime and even for your heirs? You know, what sort of legacy do you want to leave? And that naturally leads into a discussion about, well, how long are we talking about here to investing this money, right? And once we get an idea of time horizon, then we can start forming the idea of risk tolerance and what sort of asset allocation they're comfortable with. So it really starts with that first conversation, right, Scott? And you go through the same thing when you're talking with clients is, exactly where are we at today, kind of assessing the situation before you get into building the portfolio.
Yep, and I think that's a good point, Travis. Sometimes investments are recommended just based on people's age or maybe their risk tolerance. But I think you're missing out on a bigger picture by not understanding what the goals are, what the cash flow needs are. And I think that's where our conversation helps to determine what kind of investments would be a good fit.
Yeah, and once you've determined that, then you can start having the conversation about what are you building in the portfolio? What sort of securities do you actually include? So for our firm, we focus a lot on asset allocation, having the right diversification in the portfolio, rebalancing, right? And just not trying to time the market because we've found and we believe that no one can do that successfully time after time, right? It's going to be very hard for anyone to do that successfully. Can you talk about how we think about building a portfolio? What goes into that for us?
Yep. I think you hit the nail on the head. Diversification is important for us. But beyond that, we also look at active versus passive strategies when it comes to choosing the investments. So our philosophy is where we view the market as efficient. That's where we may lean more towards passive fund managers, and where there may be inefficiency, there's the word alpha that's thrown around, which is basically, is there any differentiator or any gain by using a particular fund manager or certain process? That's where we may look for more active strategies when it comes to different funds. But just from a high level point of view, that's been our strategy, just because it comes also down to cost, right? So for more passive strategies, it should be cheaper. For a more active strategy, it tends to be a little bit more expensive. There may be some cost there just because there is some active management. So we want to make sure that the additional cost is worthwhile, is worth adding to our investment lineup and portfolios.
Yeah, that's another part of this ongoing debate in the investment world is between only being a passive investor versus active investor. So, there's different ways to think about this. Can you share a little bit of your thought process on the whole active versus passive debate? Or is there a world where you can combine both of those into a really good portfolio?
Yep, I think there is a world that we can combine both of those, and that is really what we try to do. And just because we have our set portfolios as they are today, it doesn't mean that we're not interviewing active fund managers, reviewing the passive strategies, making sure that whatever is in the portfolios is still a good fit. So I think there is a world where they both work, and that's currently how we view it. I guess we can get a little bit more granular From what we're looking at for active strategies, it may be small caps where there's thousands of companies that have to be vetted, or international companies that we may not be familiar with in the US, as well as the bonds or fixed income, where we may want a little bit more scrutiny or screening when it comes to choosing these investments. I think for the past couple of years, on the passive side, right, we heard about the Mag 7, these tech companies. It doesn't take a whole lot of extra screening to know who the biggest companies are in the US. But where it comes to additional insight, additional research, that's where we feel like the value is for active fund managers.
Yeah, and I think a lot of this comes down to what can you actually control. And when you're building this portfolio, you can't control what the market does, right? That's a big unknown. You can control the expenses of the funds that you're using. And so if you're building a portfolio that, you know what you don't know what the performance is going to be ahead of time, but you know that if you can reduce the expense ratio on the funds, that'll tilt the scales in your favor for achieving better performance. The passive funds that we use and that a lot of people talk about from these major companies, they tend to have lower expense ratios because there's not that additional layer of active management fees built in. Doesn't mean that they'll perform better, but if it's one thing that we're looking to control is the expenses, then that's where we'll focus some of our research on, is what are the actual underlying costs to investing in these funds.
Yep. And I think at the end of the day, Travis, we talk about this all the time, where we may not be able to control the outcome, but we can control the process. And that's where our expertise, our process, that's where we can lean on that and say, as long as the process makes sense and we have justification for our decisions, then whatever the outcome is, kind of is what it is.
Yeah, and people have done very well investing in funds that track the general market. There hasn't been as much of a need for picking individual stocks and to achieve good performance. So, turning from that, what sort of resources do we use when we're doing our portfolio research and our building our models?
Yeah, I think that it's maybe surprising to people since we are a smaller local independent firm. They may assume that we may not have the resources that bigger brands may have, but we do have direct access to all of the big fund managers, portfolio managers, and we're talking to them on basically a weekly basis and getting their best ideas, and also being able to send our portfolios to them for review, get recommendations. So just because we are independent and we are doing everything locally doesn't mean that we're not getting these overseen or getting feedback from outside parties.
We have a internal investment committee made up of our team members, our advisors, and that's one thing that we talk about during our meetings is, what are we noticing out there that our clients should be, at least know about, or maybe adding to our portfolios. We get that information from our third-party research partners or anyone that can provide us with that information. Even our custodian, Charles Schwab, has great ideas that we can incorporate into our investment portfolios. So I think it's doing that research one, but also getting together as a team to talk about it. And Scott, you know that I've had ideas before that I brought up to the team, and sometimes we get some different feedback, good and not so good, but that's part of the process that we have to kind of battle test our ideas before we put it into practice. And we
Yeah.
always try to do it for our own portfolios first, right? So we're trying our own cooking before we feed it to everybody else.
Yeah, and I think that's a good point, Travis. And I think what makes our job a little bit more difficult is all these fund managers are knocking on our doors and giving us their best ideas. But ultimately, it's our responsibility to make sure that we're taking care of our clients and making sure that whatever investments we choose is for their benefit. That's the fiduciary standard that we talked about in a previous episode, but it's always keeping the client's goals in mind. I can't even count how many different fund managers express different investments that sounded great. They promised great returns, lower risk, but at the end of the day, either the expenses are high or the risk may be a little bit higher than our clients want. So that's ultimately our role, to filter all of this information that we're receiving and making sure that we're making the best decision for our clients.
Yeah, we end up saying no, right, to these ideas more often than we say yes. And I think investment managers should be doing that. Not to be mean, but we understand our clients and their needs better than anyone else. So we would know, and we should be the keeper of their good decisions for their funds. And if there's ideas out there that we think are maybe potentially good, we'll try it out in our own portfolios first and see how it actually works before doing that for everybody else. After the portfolio has been constructed, Scott, what happens then? Investments have been made. We were pretty comfortable with our process. What's the next step to keeping investments in check?
Yeah, so we're monitoring the accounts on a daily basis. I know we pull our reports and make sure that the accounts are in good order. Sometimes dividends and interests are generated, and we make sure that those are deployed appropriately. Also, just rebalancing, right? We've been very fortunate over the past few years where the stock market has been doing well. So that's where sometimes a client will be more in a balanced or conservative portfolio, but over time, just naturally the stocks will outweigh the more conservative parts of the portfolio. So rebalancing back to the desired risk, to the desired models. And then also, just as we talk to these fund managers, we may change the investments now and then. And I guess, Travis, how frequently would you see investments change in our portfolios?
Yeah, because you'd like to give the investments that you have some time, right? And of course, we're having our investment committee meetings. We're looking at the performance and of the funds, making sure that it's doing what it's supposed to be doing based off of the holdings. But, we'll look at making changes at least once a year. We have those committee meetings. We do those meetings with outside research partners. And we'll see if that fund still has its place in the portfolio. I don't like to change it too often because then you're kind of getting into, are we just making a change because we should make a change or for the sake of it, or is this really going to be beneficial for the model? But I think once a year is actually probably a good cadence to be doing that.
Yep. And Travis, just to clarify, are there any decisions made regarding these funds based on anything other than client needs or client goals? Like, is there any commissions that we're getting paid from fund managers or any kickbacks for changing into a different fund? Can you talk about maybe some third party influence that may influence decisions?
Well, that's the beauty of being independent, right? And not having any of those third party financial relationships. We don't get paid by anyone besides our clients. And so we don't have that conflict of interest that may be present in other cases with other firms where they are getting some sort of compensation for recommending a certain product or a certain fund. That's just not the case with us. And that's how we intentionally built this out, is we don't want to have that conflict of interest. We're truly choosing investments based off of their use to our clients and that it would be the best option for them to invest in. So there's no other forms of compensation that would be going towards us from these investment companies. And that's the way that it should be. In my view, we don't want to invite even the appearance of having any sort of conflict of interest to sway our decision making. It's purely based off of what we think would be best and what would work best for our clients.
Yeah, and I think that's why we interview all of these fund managers. We want to hear what their best ideas are and then ultimately filter all of them out. So I'm happy with our process and the fact that we don't have any third party influence on our decision making. And I guess, Travis, to wrap it up, I think some clients might think once they pick their certain portfolio, they're stuck. I guess, can you talk more about the annual conversations or semi-annual conversations we have with clients just to make sure that their investments are a good fit for them?
Yeah, and I'm surprised that we made it almost 16 plus minutes into this video without mentioning the keep it simple strategy, which is, as many of you know, our framework for investing decision making for our clients. And this is something that Les Andrews had created during his career. We go over that with clients at every meeting. Right. So meetings will typically happen 1 to 2 times a year to review different parts of the financial plan, investments being one of them. And that keep it simple strategy is integral part of that investment discussion. Because if there has been any changes in the client's lifestyle or their situation that would require us to make a change on the investments, will figure that out by going over that chart. And so it's not hard to go from one column on that page to the next, or to get more aggressive or to get more conservative. Most people aren't making a change at every meeting, right? They'll stick with whatever risk tolerance they've chosen. If there's a change in their life, or maybe they've retired, or, in some cases they've, come into a bunch of money from an inheritance, or, maybe they win the lottery, then that might require some changes. But it's not hard to do that. And if we're going to make a change, I tell people, let's change one notch at a time. So we're not going from very aggressive to very conservative in one swoop. We might go from, more of a moderate to a balanced in that fashion.
And it's not like one account or all accounts have to be invested similarly, right? They could have different goals and different needs for cash. So it's not where they choose one model and they're stuck with it for all of their accounts.
Yeah, and that's a good point. Even spouses can have different risk tolerance scores. And, one spouse may be more on the aggressive side and one may be more on the conservative side. That's okay. If, as long as their situation kind of supports that, which we explain that to all of our clients, what their situation calls for on the investment side. It's okay if they're not totally aligned, on their investment risk.
Yep. Great points, Travis. And I think the main thing is we want to make sure that we have the client's goals in mind whenever we choose investments. And we want to make sure that it's transparent and clear how they're invested. So I think the KISS page that Les created definitely helps to make sure that we're on the same page as the client and that the client is fully aware of what risks they're taking in their portfolio.
Yeah, exactly. Exactly. And so this is a topic that, obviously we're very passionate about, right? We dedicate a good chunk of our time to focusing on investments and building great portfolios for our clients. It's a good time to mention that we do second opinions for anyone that has questions about their own portfolios. Come and see us. We always offer a secondary or second pair of eyes for no charge, just to even explain what's happening in your account, what your actual holdings are, what are you invested in. Even that, I think, for a lot of people can be helpful. So if that's something that anyone has a need for, please give us a call or contact us, and we're happy to help you.
Sounds good, Travis. I think that's a good place to end. Until next week, we'll talk to you soon.
Thanks, Scott.